What if I told you that a few simple financial moves can save you thousands of dollars before December 31st? You see, while many of us wait until March and April to file and plan taxes, by the time March and April comes along, most of the tax reducing opportunities have passed. That is because the tax planning deadline is not the end of April, but it's the end of December. I'm going to be discussing how you can reduce your taxes and save thousands of dollars in taxes before December 31st. First, make sure to hit the like, subscribe, drop a comment down below, show the channel some love if you can. In case you haven't met me before, my name is Leon Mann. I'm a licensed wealth consultant with Money Assist Financial. And what I do, I help hardworking folks add an additional multiple 6 to 7 figures to their retirement portfolio. I also help them to protect the hard-earned money during retirement. The best time to plan for taxes is by the end of the previous year. The first thing is you want to maximize your RRSP contributions. Remember, guys, that you are allowed up to 18% of your RRSP in terms of contribution room every single year. And if you have never used your TFSA, the good thing is that your contribution room carries forward. So some of you are probably sitting on a lot of contribution room that you probably never even knew you had. One way to do this is by going to your CRA website, and you want to look up how much contribution room that you have left. This will tell you how much you have available to contribute to an RRSP and also have the tax reduction or tax sheltering advantages of sheltering your taxes, right? And it can save you a lot of income in terms of getting back tax refunds at the end of April, May. The second thing is tax loss harvesting. Tax loss harvesting is mainly used by investors. And the way that they go about using this, if you had investments that have not made money, or if you had losing investments, what they're able to do, they're able to offset the capital gains by basically using the capital losses. And thus, they're able to reduce their capital gains taxes, right? This is one way smart investors will try to manage their losses, because they're basically turning a bad thing into a good thing, because even losses can actually be valuable when it comes to tax planning and when it comes to investing, right? So the second way is through tax loss harvesting. And this is obviously if you had investments, right, where you want to use your losses as well as your gains. The third way is through spousal RRSPs. A spousal RRSP allows you to do two things. The first thing is if you are a spouse in the higher income tax bracket, you will get a tax benefit by contributing to your spousal RRSP. And also, when retirement comes, then your income is balanced. That means both you and your partner have the same amount of income. So you pay the same amount of taxes as opposed to having to pay a lot of taxes, right? So it really reduces the household tax burden during retirement. And while you're working, you can also have a tax benefit in the process. The fourth way is through charitable donations. What better way than to give and support to a worthwhile cause and also be able to reduce your taxes? This is what charitable donations is all about, because you're basically supporting a worthwhile cause that you really care about. But the way to go about doing this is you want to use your investments that have went up in value. So if you have investments and you keep your donation receipt and you use these investments, for example, to support a charity or to make a donation, you're able to reduce your capital gains taxes, in other words, right? So you will get back a tax refund for this. The fifth way is to use your TFSA more strategically. Remember, guys, with a TFSA, you can use it literally tax-free, right? You can take your money out tax-free, and your money also grows inside your investment account tax-free. But if you take your money out, remember that you will lose your contribution room for the year, but it will grow back the following year. So this is one way that you can actually at least avoid the penalties by the CRA if you are over contributing, is by taking it out strategically and reinvesting the next year. Because remember, once you use up the contribution room, you can't get it back until the following year when it grows back, right? So using your TFSA strategically also counts towards tax reduction. Finally, the sixth way is through income splitting opportunities. One way to go about doing this is, if you have a large amount of investments, is through giving your partner a loan in the form of your investment. So what happened is, this is like a loan that you can usually, instead of gifting your partner, you can loan your partner part of your investments and have your partner pay 3%, right? 3% as the rate. It's called a prescribed loan rate. And the prescribed loan rate right now in Ontario could be around like 3%. So if you loan your partner part of your investments and he or she is able to pay 3% at the end of the year, what happens is that you will have a tax write-off, for example, if you're earning a higher income. And the good thing about this is that if the investments is over 3%, whatever amount is over that 3%, then he or she can report that as income, for example, right? But basically what happens is you have a tax write-off by simply loaning your partner as a loan. It could be 3%, but 3% is the prescribed rate loan. And that is how, if you have a large amount of non-registered investments, for example, you can have a tax write-off. It's only for investment income, however, right? So as you can see, guys, the biggest mistake that many of us make when it comes to tax planning is we simply wait too long, where all the opportunities are gone. But the biggest difference between someone who tax plan in April versus someone who tax plan at the end of December is basically thousands of dollars. Remember this. This is something that I've learned and I've kept in my mind. For example, when it comes to tax filing is done at the end of April, but the real tax planning is done at the end of December. If you keep this in mind, then things will actually work out more in your favor. So if you found value in this, feel free to drop a like, subscribe, and I thank you guys for tuning in. Until next time, peace and love.